All right, thank you very much for giving me a chance to present in front of this audience. So this is a report on work that Martin Uribe and I have been doing on and off over the past 20 years, and I thought that I gave it the title The Neo-Fischer Effect, and I want to start by giving the bigger context what we are thinking about. So this is a very standard problem of thinking about controlling the rate of inflation. That's what central banks do. In the past, going back maybe before 2000, very often this type of problem was, oh, we would like to have an inflation rate of 5%, but we have inflation rate of 10%, and how can we make sure that we don't keep overshooting? And the focus of that question has changed since the financial crisis of 2008. Many central banks around the world find themselves in the opposite position. They have a certain inflation target. Many of them have 2%. The inflation outcomes are not at target, but the deviation is an undershooting. So it's about the problem of how do you generate inflation in the sense that you are able to reach your inflation target. Okay, so that's the general context, and how the particular model you work with informs you about how you can reach your target. So I want to first start by explaining what we take to be the Neo-Fischer effect. There was some mentioning of this concept earlier, and we just want to be clear because I think different people mean different things by what Neo-Fischerianism is and what the Neo-Fischer effect is. So I'm in particular reporting on this agenda that we did with Jess and mainly Martin, and as you see, the first paper I mentioned is by Martin Uribe alone. Okay, so let's start with something simple, which is the Fischer equation. So I have here I is the nominal interest rate, R is the real interest rate, pi is inflation. And I want to think about what is the effect of an increase in the nominal interest rate I, which I take to be the nominal interest rate that the central bank controls, on inflation. To make that question well defined, I'm going to sort it into this 2x2 matrix, and I'm going to ask about what are the effects of transitory increases in the nominal interest rate, what are the effects of permanent increases in the nominal interest rate, and then I'm going to distinguish between what's the effect in the long run, on inflation, and in the short run. So the way we drew this table might not be the best way, because I'm going to go through the 4 boxes like this, this, and this. So okay, so let me start with row 2, column 1. Why do I start here? Because I think there's no controversy. What's the question? The question is, there's a permanent increase in the nominal interest rate. What will be the effect on inflation in the long run? That has been well studied. This is called the Fischer effect, and I assume that everybody agrees that in the long run the Fischer effect holds. How do we typically show this? We just take a plot of long run or average inflation rates over a long period of time against average nominal interest rates, and we see that this graph is impressive. Why is this graph impressive? If we draw a 45-degree line, then it looks like the points line up almost like on a parallel shift up from the 45-degree line. What does this say? That says that inflation and the nominal interest rate move 1 for 1, and this distance, this is a sample of 25 OECD countries, seems to be quite constant. That would mean that there is a certain real interest rate, right? And that if you have a higher nominal interest rate in the long run, you're going to have a higher inflation rate, right? And so that is, I guess, the uncontroversial part. That's the Fischer effect. That's the long run effect. And in particular, it means that by having high nominal interest rates, you cannot control inflation. So it's not a downward sloping path in the long run, right? And so this gives me an opportunity to show a quote from Bob Lucas from his Nobel lecture. He said, "Central bankers and even some monetary economists talk knowledgeably of using high interest rates to control inflation, but I know of no evidence from even one economy linking these variables in a useful way, let alone evidence as sharp as that displayed in figure." What Bob Lucas was having in these figures was pictures about average money growth and average inflation in the long run. So what we have here is long run inflation and long run nominal interest rate. So I think there's no debate. And so if you have a higher nominal interest rate, you're going to have a higher inflation rate, and the relationship is 1-for-1. So that is why this box is an upward arrow, and it's 1-for-1. So now we go here to this box. What is that? That's the question. If you have a transitory increase in the nominal interest rate, what is the effect on inflation in the short run? That is maybe unfair to some people, I'm going to say, is where much of the work of Cristiano, Eichenbaum, and Evans and other people have contributed. So I think there's also no controversy. We all agree this is the bread and butter of the central bank. If there's a transitory increase in the nominal interest rate, then this is going to, in the short run, raise, that's at least the narrative, the real rate, and inflation is going to be down, so inflation is going to fall in the short run. So for example, if you remember Marty's impulse response graph, this is what he was into, and he showed, and this was a challenge to its model to explain. So transitory increases in the nominal interest rate, lower inflation in the short run. I think that box is also well described. So let's go to this box. I have not much to say. I don't think there's anyone who believes that if you have a transitory increase in the nominal interest rate, you will have a long-run effect on inflation. Most of us believe in long-run neutrality. So here comes the problem, and I think that has been a general feature of macroeconomics for a very long time, is how to link the short and the long run. So now I want to consider row 2, column 2, which we call the Neo-Fischer effect. So the question is, suppose you have a permanent increase in the nominal interest rate, what is the effect on inflation in the short run? That's our question. Suppose you have a permanent increase in the nominal interest rate, what's the effect on inflation in the short run? In the long run, we all agree that's the same, but what happens in the short run? And that's what we call the Neo-Fischer effect, and we say it's a positive effect. So the point is there's a different behavior of inflation whether you have a permanent increase in the nominal interest rate or a temporary increase. And so this is the Neo-Fischer effect. And here I think from the way Harald used the term earlier today, and maybe you used it, it was not in this precise way. So this is just to be clear. What we call Neo-Fischerian is a permanent nominal increase in the nominal interest rate. We want to know what happens to the inflation rate in the short run. Is the up arrow, why is there an up arrow? Because that's what's in the data. So I'm going to show you, there's a paper by Martin Uribe, solo authored paper, which is called the Neo-Fischer effect in the United States and Japan. And he has like a model, an econometric model with unobservables, with 4 shocks, some temporary shocks, some permanent shocks, some identification assumptions. And he's interested in estimating the effects of transitory and permanent nominal shocks on inflation. And let me explain to you what he does. So let's first start, again, sorry, I'm a little bit reverse here, start with the right column. That is in some sense the same exercise that Marty does, but when Cristiano, Eichenbaum, and Evans do their analysis of what are the short-run effects of monetary policy shocks, they do not even consider the possibility that there can be a permanent one. So our identification is slightly different, but this should be, if things are robust, this has to be CEE or all your work. And so let's see if this is what Martin gets. This is for the United States, and I only brought one picture because I have 25 minutes, so I want to be short. So this is the impulse response. So this is a shock that raises the nominal interest rate on impact. The way it is drawn here, it raises the nominal interest rate by 100 basis points. And then what is the question? What happens to inflation and what happens to output? So what Martin identifies in his empirical work is that, in fact, 100 basis points increase in the nominal rate that is temporary lowers inflation by 50 basis points. So his interpretation of his results, just as a comment to Marty, is why doesn't he have to struggle a lot? Because the VER guys have permanent and temporary effects not sorted out. They just have a temporary effect. If you distinguish, you get very clean what we all think is true, what the bread and butter is of monetary policy. You raise nominal interest rate temporarily, you lower inflation. That's the mechanism. And on top, you get the standard result that we expect. So real interest rate in the short run go up. Because real interest rate go up, you have a damper on demand, and it is estimated that output also declines in the short run. So far is all known territory. So now we move to the left column, and this is what we mean by the Neo-Fischer effect, and that was what this empirical work by Martin is trying to answer. What happens if you have a shock that in the long run is going to raise nominal interest rates by 100 basis points, and they're also going to raise inflation by 100 basis points because the model imposes that the Fisher effect holds ad infinitum in the long run, right? So that's it. So then he asks, okay, a shock like this, what does it do to the nominal interest rate in the short run? And actually, he finds that the point estimate is a 25 basis point increase. And then it goes up. This is the part that he was looking for in the data. What would the data give him? Most people who come to an answer to that question with the intuition of a short run effect, what do they say has to happen to inflation on impact? They have to be here. But his estimates show inflation goes up on impact, and in fact actually goes up by more than the increase in the nominal rate. So what does this mean? On impact, if you have a permanent innovation, the real rate falls. So there's this dichotomy. If you have a temporary increase in the nominal rate, you increase the real rate. If you have a permanent increase in the nominal rate, you lower the real rate. And consistent with that interpretation, what Martin finds, actually, it is not contractionary, it is expansionary. Okay? So that is what we mean by the Neo-Fisher effect, and that's why we say a permanent increase in the nominal rate has increases inflation on impact. So that's the thing. So this evidence is to say, why do I say this arrow is up? That's the substance for this. Okay, so now that I have explained what the Neo-Fisher effect is, and I have given you some empirical support that that is what's going on in the data, why am I interested in that? I mean, why am I interested in the Neo-Fisher effect? Because this ties to our earlier work together and with Jess. There is a link about the Neo-Fisher effect and our thinking about what you do if you lower the nominal interest rate to 0 and 10 years later you look at inflation and you say, my model tells me that since I have been holding the nominal interest rate at 0, my model tells me inflation should be overshooting. I have 3% inflation, but instead I'm still at 1%. That's the type of problem we want to address. So this is how we tie it to exiting the liquidity trap. This is not a paper about one country, but Japan gives the most beautiful example, and not all countries are the same in all liquidity traps. And Barry said, you know, the Great Depression was different, but let's look at Japan. So Japan went, as Mike just showed the same picture, they went to the effective zero lower bound in 1995, and in my opinion is a step function. Since then, they never ever changed the nominal interest rate. Why does this graph look messy? Because I put in also the booms and busts. So clearly, they kept the nominal interest rate at 0 over 1, 2, 3, 4 cycles. So this is not the nominal interest rate that was lowered to 0 necessarily in a cyclical way, because we had 4 booms and busts. What was the outcome of this policy on inflation? Well, I put there 2% inflation target, which is official since recently, but basically it has resulted in deflation in Japan on average of 75 basis points, right? So if you come with a conventional view of a macro model, if you see these two things together, putting the nominal interest rate at 0 for 23 years and inflation below target, your model gives you only one way to match that data. I mean, the only way you can match that data, well, that's my claim, is that constantly the poor economy was hit by surprises, by negative surprises to the natural rate, right? And so this is a very nice graph from a paper by Vasco Correa for US data, so I'm switching now from Japan to US. He asked, within the standard context, if we think about the liquidity trap of the United States, there's a shock here, which is the natural rate of interest. So this is what we were forecasting in 2006 to fit the data. The crisis come. Then in 2008, we were forecasting this path. But now we do it again in 2010, and we want to explain why inflation is below target and the nominal rate is at 0. The only way out we have is to say, oh, we were wrong. No, it's still really low. So you have one surprise. And then, of course, the US got out. The US is not in a liquidity trap. The US got out in 2015 Q4, right? So that is the only way that the standard model allows you to think about this problem. So what we have been working on with Jess was to say maybe there's another way to think about this problem. And we don't want to say that a country goes into a liquidity trap for 2 or 3 years is the problem we call the perils of Taylor rules, but we want to say if for more than 10 years you have been at the zero lower bound, and in the theoretical framework that you have, that if you have a nominal interest rate at zero, inflation has to be coming up and you still are falling short, you might want to consider an alternative interpretation, right? So this is what we did. We have this. I'm not violating the budget constraint yet, right? Okay, 10? 7. I would say the sum of Woodford and Schmitt Grohe is 50 minutes. Okay. But that's fine. Okay, 7 minutes. Let me just give you an interpretation of what we do. What we pointed out, when the famous Taylor rules started taking place, people were using it, and it has many desirable properties. I would say it has conquered probably the entire world. I teach a central bankers course in Gertsensee, no matter where in the world they come from, they use an occasion model and the Taylor rule. So what was the point we wanted to make? We wanted to say that the Taylor type of rule is giving local uniqueness, but globally it gives rise to the possibility that that you can be at a liquidity trap. Suppose we go to perfect foresight and make it simple forever. That's the point. Okay, and in my 7 minutes, let's see, I don't have that much time, but it's so easy to see, I'm going to show it to you. So I'm going to go to flexible prices, endowment economy, to make it super easy to see. So there's a Taylor rule here, which is, I wrote it in gross terms, 1 plus the nominal interest rate is the Taylor rule. That's the right side of the max, which is 1 plus I star. Suppose you think the real rate is 3%, 1%, 2% inflation target, that would be 3%, plus the famous Taylor coefficient alpha pi, which is bigger than 1. And you have here the deviation of inflation from the inflation target. And the only thing we did in the work with Jess, we put a max operator in front and said, well, we don't believe that the central bank will ever put the nominal interest rate negative. So we made something that was a line, we gave it a kink, okay? And then in any model, you have something like an Euler equation, which is my second equation, which says the marginal utility of consumption is beta times 1 plus the nominal interest rate times the expected value of the marginal utility of consumption divided by inflation. This has to, now let's make it super simple. That is everything there is, flexible prices, endowment economy, and I look first at the steady states. Well, since you have the kink, and the Euler equation becomes basically the Fisher equation in a non-stochastic steady state, you have this second intersection. That was the point we made in our paper with Jess, and that is why the paper was called The Perils of Taylor Rule. That entire paper was obsessed with characterizing the nonlinear dynamics of going from here to here, and in sticky prices and different variations. But the key point is you have this second steady state, and you can have dynamics going in both ways. Just one comment, the perils of Taylor rules are not just the perils of Taylor rules. There's a nice paper by Nakata and Schmitt, which say even if you do optimal discretionary policy, you always have this multiplicity. You can also be in the liquidity trap. So this is not just very specific to this particular rule. Okay, so if your view of the world, you buy this, right, then you can have a different interpretation of how come there has been maximum monetary stimulus for 23 years, and nevertheless, inflation has never gone up. In particular, since the announced inflation target is not minus 75 basis points, it's higher. Well, the interpretation would be, after so many years, probably the fundamental shocks that triggered this have dissipated, and somehow the expectation of being there forever, this is the new normal, has sunk in, which is the implication of our model of the perils of Taylor rules. So let me come to the part where I assume I was given the chance to talk here, because the title of the session is Conventional and Unconventional Monetary Policy. So how can you make this steady state disappear? And it's sort of trivial what we say. Well, if you don't want to be at the zero normal rate, just don't be at the normal rate. That's it, right? If you don't want it, so as my colleagues at Columbia say, if you want to hire a woman, just hire a woman. Okay, so don't say there's nobody good. Just hire one. Okay, so the same thing is here. If you don't want to be at the liquidity trap, just don't be there, right? So then we developed that argument given that I don't have that many minutes, in a more complicated model where we have wage rigidity. Why do we have wage rigidity? Because we want that there's pain, that it hurts to be at the zero lower bound, right? We have used this idea to explain the Ben Bernanke concept of jobless growth recovery. So we say that if you have this downward wage rigidity, but you can be trapped in this unintended steady state, the economy is growing, so let's go to that steady state. The economy will be growing at the usual rate, 1.5% per person, because that's our TFP growth, or 1%. But you have involuntary unemployment because there's downward wage rigidity. And so the normal interest rate is at 0, and inflation is at the liquidity trap. So what we say here in this graph, we say, suppose in period 10 you make an announcement that if you don't want to be forever at the 0 rate, you start tightening. And so here we just ad hoc said, you tighten 25 basis points nice and slowly per quarter until you reach the inflation the target. What happens in this model? And as you can see, that's why the graph is called tightening is easing. You have the Neo-Fisher effect. Because what happens here, if you kill the liquidity trap steady state, it is true that on average, in the future, normal interest rates are going to be higher. So it's like a permanent, by going on this exit strategy, is like a permanent increase in expected normal rates and therefore in expected inflation. And therefore the Neo-Fisher effect kicks in. And so tightening here starts raising inflation. When inflation rises, real wages, which were bounded below, start falling. So unemployment falls, means employment rises. And you even have transitorily a little bit higher growth rate than normal. Okay.